Andrew Jackson made a decision in 1832 that would echo through American history for the next 77 years. He killed the second bank of the United States, America's central bank. He thought he was protecting ordinary Americans from a corrupt financial elite. What he actually did was set off a chain of events that led to one of the worst economic depressions of the 19th century. This isn't a simple story of good versus evil. It's a story about concentrated power, personal grudges, political warfare, and the law of unintended consequences. It's a story about how killing a flawed institution can sometimes be worse than reforming it. And it's a pattern that keeps repeating because 77 years later, after the panic of 1907, America created the Federal Reserve to solve the exact problems Jackson's decision had created. Hey, I'm Brandon, and welcome back to My Money Mint, the channel where I dive into topics related to money and wealth. All right, let's get into it. The Second Bank of the United States was created in 1816 with a 20-year federal charter, 5 years after the first bank's charter had expired. The War of 1812 had been a financial disaster without a central bank to coordinate war financing. So Congress tried again, creating a bank with $35 million in capital, with the government holding 1/5 of the shares. It had 25 branches throughout the country. The bank struggled in its early years under William Jones, then Langdon Cheves. But in 1823, Nicholas Biddle became president, and everything changed. Biddle came from a prominent Philadelphia family, exactly the kind of Eastern elite that frontier politicians like Andrew Jackson despised. Under Biddle's leadership, the bank stabilized lending practices, required hard currency backing, and produced an improved financial climate. By the end of the 1820s, the bank had built a solid reputation. But Andrew Jackson hated it. As the champion of the common man, Jackson opposed the concentration of power in the hands of what he called a moneyed elite, people like Biddle, at the expense of ordinary farmers and workers. Jackson believed the bank concentrated too much economic power beyond the public's control. And his opposition wasn't just philosophical, it was deeply personal. In the 1790s, Jackson had been burned by depreciated banknotes. He'd accepted paper currency that later became worthless, nearly bankrupting him. This experience shaped his entire worldview about banks and paper money. For Jackson, this wasn't abstract economic theory, this was personal. The banks had screwed him once. He wasn't going to let them screw America. In 1829 and again in 1830, Jackson made clear his constitutional objections and personal antagonism toward the bank. Despite the Supreme Court ruling in McCulloch versus Maryland that the bank was constitutional, Jackson continued to challenge it. He believed he had the right to judge constitutionality independent of Congress or the courts. Nicholas Biddle knew this was coming. In early 1832, he made a calculated political move, working with Senators Henry Clay of Kentucky and Daniel Webster of Massachusetts, leaders of the National Republicans who opposed Jackson. Biddle submitted an application to renew the bank's charter 4 years early before it was set to expire in 1836. Why so early to force Jackson's hand before the 1832 presidential election? Biddle had surveyed Congress and realized enough votes existed for recharter, but not enough to override a presidential veto. Clay and Webster secretly hoped Jackson would veto it, believing this would damage him politically and lead to his defeat. They assured Biddle that Jackson wouldn't dare veto the bill so close to an election. They were wrong. On July 10, 1832, Jackson issued one of the most important veto messages in presidential history. Attorney General Roger Taney and Kitchen Cabinet member Amos Kendall helped write it, but the ideas were purely Jackson's. The veto message didn't hold back. Jackson characterized the bank as hopelessly corrupt and argued that the powers conferred upon the bank were not only unnecessary, but dangerous to the government and the country. The veto was a polemical declaration of Jacksonian philosophy pitting the planters, the farmers, the mechanic, and the laborer against the moneyed interest that benefited the wealthy at the expense of common people. Jackson contradicted the Supreme Court, denied the bank's constitutionality, and affirmed his right to judge that question independently. The bank immediately became the main issue of the 1832 election. Jacksonians framed it as a choice between Jackson and the people versus Biddle and the aristocracy. Clay and Webster had gambled that the veto would hurt Jackson. They lost spectacularly. Jackson won over 4 times as many electoral votes as Henry Clay, the people had spoken. But Jackson wasn't satisfied with just vetoing the recharter. He wanted to destroy the bank before its charter expired in 1836. So in 1833, Jackson ordered that all U.S. government deposits be withdrawn. No more federal funds would go into the bank. Existing deposits would be consumed paying off expenses, while new revenues were placed in 89 state-chartered banks, nicknamed pet banks. This is where things get really interesting. Nicholas Biddle wasn't going down without a fight. What happened next became known as Biddle's Panic. And it's the dramatic middle act that often gets overlooked in this story. Biddle deliberately crashed the economy to force Jackson to back down. He called in loans. He restricted credit. He created business distress and unemployment throughout 1833 and 1834. Merchants couldn't get loans. Businesses closed. Workers lost jobs. And Biddle made sure everyone knew why, because Jackson had removed the deposits. Merchants petitioned Congress to recharter the bank and restore the deposits. They begged Jackson to relent. Jackson's response became legendary. "Go to Nicholas Biddle," he told petitioners that Biddle had plenty of money but was deliberately withholding credit to create artificial distress. Jackson held firm. Biddle's plan backfired spectacularly. Instead of forcing Jackson to capitulate, Biddle proved Jackson's point about concentrated power being dangerous. If one man, Nicholas Biddle, could crash the economy with a stroke of his pen, didn't that prove the bank had too much power? By early 1834, public opinion turned against Biddle. He was forced to ease credit restrictions. Jackson had won. The Senate, led by Henry Clay, censured Jackson in 1834, formally disapproving his behavior. This was the first and only time in American history the Senate censured a president. But Jackson didn't care. He'd broken the bank. In April 1834, Congress failed to override Jackson's veto. In 1836, the bank's federal charter expired. Biddle secured a state charter from Pennsylvania to keep it operating, but in 1841 it went out of business from faulty investments and economic distress. The Second Bank of the United States was dead. Jackson had won a complete victory. By 1836, the U.S. Treasury had a budget surplus with no public debt. The Deposit Act of 1836 ordered distribution of the federal surplus to various state banks throughout the country. Jackson's pet banks were thriving. Everything seemed perfect. Except it wasn't. Without the Second Bank's oversight and national direction, the pet banks went on a lending spree. The number of commercial banks exploded from 220 in 1830 to 506 in 1834 to 729 in 1835, 1,837. Credit became incredibly easy to obtain, and all that easy credit flowed into one place: Western land speculation. The Indian Removal Act had opened vast territories for settlement. With credit easy and the federal government selling land aggressively, speculation went insane. Land sales jumped from $4.9 million in 1834 to $24.9 million in 1835, 1,836. People were buying land with borrowed money, planning to flip it for profit. Classic bubble behavior. Rampant speculation drove prices higher, creating massive inflationary asset bubbles. The lack of oversight that the national bank could have provided allowed the speculation to spiral out of control. Jackson's pet banks were effectively fueling a speculative mania. By mid-1836, Jackson realized things were getting out of hand. On July 11, 1836, he issued the Specie Circular, an executive order mandating that all public land sales over 320 acres must be purchased in specie, actual gold or silver coin, not paper money. Jackson thought this would cool speculation. Instead, it created a shock to the banking system. The Specie Circular drastically shifted gold and silver from Eastern banks to Western banks at perhaps the worst possible moment. Paper money that had been flooding the system suddenly depreciated rapidly. Monetary reserves in New York City deposit banks fell from $7.2 million in September of 1836 to $1.5 million in May 1837. Then came the international trigger. Great Britain, America's prime trading partner, pulled back on lending and required trade payments in specie. Eastern banks suddenly realized they were massively overextended. They didn't have the reserves to meet demands. The inflationary asset bubbles popped. On May 10, 1837, banks suspended specie payments. They would no longer redeem commercial paper in specie at full face value. New York banks suspended payments, prompting banks across the nation to do the same. The Panic of 1837 had begun. The economic collapse was catastrophic. Within 2 months, losses from bank failures in New York alone aggregated nearly $100 million. Out of 850 banks in the United States, 343 closed entirely, and 62 failed partially. The system of state banks received a shock from which it never fully recovered. The panic led to 618 countrywide bank failures, 25% of the workforce unemployed, and commodity prices dropping by 50%. Over 40% of all banks failed, businesses closed, prices declined, mass unemployment spread. Railroad stock prices fell by 62.6% between January 1837 and 1843. Banking and insurance stocks fell by 31.9%. Real imports per capita decreased nearly 50% from 1836 levels. In New York, mobs invaded flour warehouses and carted away as much as possible. Despite a brief recovery in 1838, the recession persisted for nearly 7 years. From 1837 to 1844, deflation in wages and prices was widespread. The Depression wasn't over until 1843. The growth of real investment per capita fell from an annual average of 6.6% in the 5 years before the panic to negative 1.0% over the next 5 years. Average annual growth of real per capita income fell by 1.4%, drawing one of the nation's early growth spurts to an abrupt close. Among 19th century U.S. financial crises, only the Panic of 1893 posted a larger decline in investment. The Panic of 1837 was one of the most severe economic collapses in American history. So what caused it? Democrats blamed the bankers. Whigs, the new political party that formed in opposition to Jackson, blamed Jackson for refusing to renew the bank charter and for withdrawing government funds. Modern historians give mixed assessments. The reality is complicated. Jackson's personal vendetta against the national bank may have cost America dearly. The bank's death removed the lender of last resort, the institution that could mitigate credit crunches across the country. The lack of oversight and uniform policy allowed speculation to run wild and made recovery slower. Jackson's actions fueled land speculation through the pet banks, then crushed it with the Specie Circular, severely overburdening the banking system in a way that triggered cascading failures. The collapse of major firms like Herman Briggs, with liabilities between $4 to $8 million and financial linkages throughout the Northeast, brought down other firms. On March 17, 1837, J.L. and S. Joseph and Company of New York announced failure, citing the Herman Briggs suspension. But there were also international factors. The Bank of England raised rates in 1836. British capital withdrew from the U.S. Cotton prices collapsed due to falling British demand. The panic wasn't purely domestic. However, a functioning central bank might have cushioned these external shocks rather than amplifying them. Was Jackson right to kill the bank? The arguments on both sides are compelling. Jacksonians were right that the bank concentrated enormous power in private hands. Nicholas Biddle proved this by deliberately creating a recession in 1833 to 34. The bank did serve wealthy interests more than common people. Jackson's assessment that the bank was created to serve the wealthy, not meet the nation's financial needs, had evidence supporting it. But Jackson's opponents were also right that killing the bank created worse problems than it solved. The unregulated state banking system couldn't provide the stability the economy needed. The boom-bust cycles became more severe, not less. The irony is bitter. Jackson thought he was protecting common people from elite bankers, but it was common people who suffered most in the Depression that followed. President Martin Van Buren, Jackson's successor, tried to solve the problem with the independent treasury system in 1840. Instead of depositing government funds in banks, private or central, the government would store its own funds in treasury vaults. This system lasted until the Federal Reserve was created in 1913. For 77 years, America operated without a central bank. During those 77 years, America suffered repeated financial panics: 1837, 1857, 1873, 1893, and worst of all, 1907. Each time, the lack of a lender of last resort meant that bank runs cascaded into full-scale crises. Each time, the economy crashed harder and took longer to recover than it should have. The panic of 1907 finally convinced America that Jackson had been wrong. When J.P. Morgan, one man, a private banker, had to personally organize the rescue of the entire financial system, America realized it couldn't depend on private citizens to save the economy. The Federal Reserve was created in 1913 to be the lender of last resort, to provide stability, to do exactly what the Second Bank of the United States had done. Jackson's war against the bank had consequences he never imagined. He destroyed an institution he viewed as corrupt and dangerous. But the institution he destroyed, for all its flaws, had provided essential functions or credit stability, currency regulation, a check against speculation, and emergency liquidity during crises. The pattern is clear. Concentrated power is dangerous, but so is no power. An unregulated banking system is chaotic and prone to catastrophic failures. The question isn't whether to have a central bank. The question is how to structure one that serves the public interest rather than elite interests, and how to prevent it from being captured by the people it's supposed to regulate. Jackson's famous quote captures his determination. "The bank is trying to kill me, but I will kill it." He succeeded. The bank died, but Jackson's victory came at a cost measured in millions of lost jobs, hundreds of failed banks, and 7 years of economic depression. Sometimes killing the monster creates worse monsters in its place. Thank you for watching My Money Mint. If this story of unintended consequences and economic warfare got you thinking about central banking and financial power, smash that subscribe button and let me know in the comments. Was Jackson right to kill the bank, or did he cause more harm than good? I'll see you in the next one.